Hi everyone, I want to welcome you to the Options for Profits video. Today I'm going to be talking about an option strategy that has a proven 95% accuracy rate. The track records that you see in this video today and every trade example that you see in this video are actual trades. They are not hypothetical. This has produced huge winning streaks of 52, that's my record, and my current winning streak is 43 winners in a row. The probabilities are mathematically fixed in your favor. It makes money even when the market moves against you, and sometimes even when the market moves dramatically against you, as you'll see. There's absolutely no market watching, meaning that the signals come out twice a week after the close, and you're not required to watch the market during the day at all. It's a strategy that gives you the ability to dramatically compound profits, which I'll discuss at the end of this video. And then the signals are exact. There's no guesswork. You get exact entry and exact exit signals, so you can follow exactly what I am doing. Now, to give you some perspective on what the probability is for a 52 trade winning streak, if you flip a coin in the air 52 times, the probability that it will land either heads up or tails up 52 times in a row is approximately 1 in 9 quadrillion. And as you can see, that is a very big number if you want to be exact. So in other words, this option strategy is not a game of chance. It is a strategy where the probabilities are heavily fixed in your favor. Now, I'm going to be talking about the options for profit strategy as applied to stocks mainly in this video, but I want to provide you with some context and show you the strategy applied to commodities as well. Here's a track record. It starts in July of last year. That's when I picked up the signals again. It had been a few years since I had provided these signals due to my extremely busy schedule. So I started them up again in July of last year, and we have yet to suffer a loss since starting them back up. And you can see the track record here. Here's 35 winning trades in a row from July through December. And then since December 1st, I've added 8 more winners. And these are those winners, bringing the current winning streak to 43. Now, again, I started this signal service in July of last year. And since July of last year, and since starting the signal service up again, we have not suffered a single loss. And these are all actual trades. None of them are hypothetical. And in fact, since inception, as I mentioned, I picked the signals up again after a couple of years taking off due to my extremely busy schedule. Nonetheless, the overall track record has produced 255 trades, 239 of those winners and only 15 losers. That's a 94% winning track record with actual trades. It has produced winning streaks, again, of 52 trades, 43 trades, which is the current. It's also produced other winning streaks, 41 trades, 32 trades, 24 trades, and 15 trades, and those are all in commodities. Now, the options for profit signals filled up last month, and there's a waiting list, so that's not available. But due to continued requests, I began offering the same strategy based on stocks. And I am confident and expect to see the same kind of winning streaks in stock signals as we have seen in the commodity signals. And in fact, in early February, I began providing those signals, and so far we have closed out 16 trades and all of them winners. So we can add another winning streak to that track record of 16. Actually, this is the track record of the trades that have closed out in February, and this is just based on a single option. This is not based on multiple options or applying any kind of money management. This is just one option per signal. And you can see it produced a total net premium of $6.63 across these 16 trades. So how do we duplicate these kind of almost unheard of winning streaks on a real-time basis on an actual trade track record? Well, to explain that, let's take a look at one of the stock trades we recently took. On February 5th, we sold a JCP 14 strike put for 30 cents. We exited that put on February 25th at 0.05, yielding a 25-cent profit or $25 per option profit in 20 days. You might say, well, big deal, $25, that's not a huge deal. Well, if you take a look at the margin that's required to place this trade, it's basically $256. This means that the trade made just under 10% on the required capital in just 20 days. And this is an actual, you can see the actual margin requirement provided by Interactive Brokers for this particular option that we sold, $256. But the real strength in this trade was how much the stock would have had to move against me just to reach my break-even level. So on February 5th, the day we were filled, JCP closed at 1981. Now remember, we sold a 14 strike, so this was almost $6 out of the money. Our break-even level was at 1370. In other words, as long as the stock did not move down $6.11, or almost 31% in the next 35 days, I would make money. Or take, for example, selling a GMCR 60 call for 75 cents when the market is trading around 45. The market will have had to move higher by 35% just to reach our break-even level, meaning as long as it can move higher 34% and we make money. Now, we were able to exit that trade in just a few days. The margin requirement was $456, meaning we pocketed a 16% return on margin in less than 1 week. Or take, for example, the most recent trade that we exited in SSYS. We exited a 45 put for 90 cents. Or I'm sorry, we sold a 45 put for 90 cents when the market was trading at over $63. The market would have had to move down 30% just to reach our break-even. We exited that trade in 4 days for a 70 cent profit, or $70 on one option. We entered on a Thursday and exited the following Monday, which was actually today. So that's 145% annualized return not using margin. Again, that's a 145% annualized return not using margin. Using margin, it's absolutely mind-boggling what the annualized return of this type of trade is. And the probability of success was between 95% and 98%, meaning we had a 95 to 98% chance that the market would not move down more than 30%. Now, just to kind of give you an example of all of our trades, this is taken from our current open orders in the put section. We sell both puts and calls. The protection means how much the market has to move against us just to break even on the trade. And you can see each one of these is a different market and different put, different strike. So this one, for example, this particular order, the stock would have to move down more than 36% just to reach our break even. Not a loss, just to reach our break even. It would have to move down more than 36% in order for us to sustain a loss. This one's at 31%. This one, the stock has to move down 24%, 22%, 28%. Look at this one. The stock would have to move down 46% just to reach our break-even level. So you can see that most of these are in the 30s. We have a couple in the 20s, a couple in the 40s. That's how much the market has to move against us just to hit our break-even level. So this is pretty typical of our signals in the stocks. Now, we've even had some trades where the market would have to move almost 50% in less than 1 month just to hit our break-even level. In fact, we have one call signal right now where the market has to move 53% just to reach our break-even level. So these types of trades happen all the time, and sometimes a stock actually will move enough to hit our break-even level. It hasn't happened to us yet, but eventually it will, and eventually we'll take a loss. But the key is diversification and proper money management and trade management. Now, below is a recent example of the put options orders that were provided earlier last month. They're very straightforward. You can see we have sell, a symbol. We have where the market is closing. We have the strike that we're selling. So the market on this particular day closed at 28.08. We are selling a March 15 expiration, 18th strike put, and we were bringing in 40 cents. So if we closed out that trade or we allowed that to expire, the return would be 2.27% without margin. The return column is all without margin. The protection is how much the market has to move against us just to reach our break even. And then if there's an earnings, which about half of our trades are earnings trades, if there's an earnings report coming out, then we list the date on those. And then we have a money management size, which I will talk about here in a minute. But as you can see, most of these provide a 2% return and require that the market moves greater than 30% on average against us just to reach our break-even level. That's pretty much average. The total premium brought in on just these options, if we were to sell, we did not get hit on all of these, but we have new signals coming out twice a week. But if we were to be hit on all of these, the total premium brought in would be $1.80, and it would only require $9,000 without margin to take each of these trades. That means that we have the potential to generate a 2% return without margin and without using any kind of trade size or money management in less than 1 month on just 1 day's worth of signals. That comes out to 24% annualized return without margin, and that's just on these signals. And again, we have signals come out twice a week. Now, let me talk about the money management size real quick. Trade size, or the MM size, is based on a $25,000 account that's willing to risk 20% of the account in a disaster trade. For example, in a $25,000 account, I would place 7 options of THRX. I know that says TRHX, that was corrected. It's actually THRX. But we'd place 7 options on the THRX put, bringing in a total of $210. Now, THRX is trading at the time of the signal at $22.70. So for me to lose 20% of my account on this trade, THRX would have to drop from $22.70 to $7.35, or 68% in less than 1 month. That is the kind of move, that is the kind of disaster move that would be required in order for me to lose 20% of my account on this particular trade. And this is assuming, of course, that I hold on to the option all the way down. And of course, we would not hold on if we were given the chance to get out. So I'm looking at the total risk of the trade in a disaster, and I'm basing my trade size on what I'm willing to lose in an absolute disaster in a trade. Now, it's very, very important that I discuss this a little bit. You look at the track record, you look at the massive winning streaks, and there is a temptation to overtrade. And I'm telling you that you need to address risk first and foremost. You address risk first and foremost, and then you base your trade size on risk, not your profit potential. A disaster trade would drop my account 20%. A disaster trade is when the stock moves 50% past the strike. Not just 50%, but 50% past the strike. So remember, it already has to move 30%-ish, some more, some a little less, just to hit our break even. I'm not talking about a 30% move or a 50% move. I'm talking about a 50% move past the strike in order for us to lose 20% on a single trade. So it's fairly conservative. In fact, it's so conservative that it may never happen. We may never see a stock that moves 50% past our strike without giving us the ability to get out at a much smaller loss. But if you don't prepare for it, it only has to happen once for the potential there to be there for you to wipe out your account, so you don't ever overtrade. What you do is you address the profit through compounding. So as your equity increases, then you increase your trade size. Now, if a trade begins to approach our break-even level, action is taken to try and mitigate the loss potential. So when I'm talking about disaster trade, I'm not just talking about a loss. I'm talking about we really got hammered and there is nothing we could do about it. However, as a stock is moving towards our break-even level, we're going to take action to try and mitigate the loss potential. And even there are some strategies we can implement that will even turn this potential loser into a winner. So when that happens, and it doesn't happen very often, but exact orders are provided with full explanations when these situations occur. Now, everyone is different in how aggressive or conservative they are with trade size. So this is just a suggested example to consider. Now, if you have a $5,000 account, then you would trade 1/5 of the trade size for the same risk ratio. In other words, if you have a $5,000 account, let me go back up here. If you have a $5,000 account, instead of trading 5 option contracts in SRPT, you would trade 1. And in a massive disaster trade, you would be risking 20% of that $5,000 or $1,000 on that one trade in a disaster. Now, that's just the benchmark. If that's still too aggressive for you, if you don't want to risk 20% in a disaster trade, if you want to risk 10%, then you would trade or adjust your trade size accordingly. So these are just suggestions based on certain benchmarks in risk and profit potential. Now, based on a $25,000 account and the suggested trade size example, we average between $150 and $250 per trade. Now, sometimes it's a little less, sometimes it's a little more. On occasion, it may be a lot more. For example, I took one trade today where the profit potential is over $3,500. So, based on the trade size example that we given. So, there are differences, but the average is going to be between $150 and $250 per trade. And we will close on average between 10 and 20 trades per month. In February, we closed out 16 trades. Now, what that means is that there is the potential to generate a 7 to 15% return on a monthly basis, and that's inclusive of the occasional loss. That also means that we could suffer a disaster trade once every 20 trades. Not just a loss, a disaster trade every 20 trades, and still have the potential of experiencing a positive return. Now, the important thing is to address the compounding so that you understand that you don't have to be overly aggressive at the beginning in order to generate serious returns with this strategy and with this signal service. So what I'm going to give you, for those who end up subscribing to the Options for Profit stock signals, I'm going to give you a spreadsheet, and it's going to have a specific money management strategy. And I'm also going to give you a 1-hour live webinar that fully discloses the exact compounding strategy that is used for this example. And if you follow this money management strategy and you make around 7 to 10% per month, you will be able to compound a $25,000 account into $80,000 after 1 year. That $80,000 turns into $209,000 after 2 years. $209,000 turns into $410,000 after 3 years, $410,000. Into $683,000 after 4 years, and after 5 years, the $25,000 account has grown to $1.028 million. Now, at the end of year 5, your per trade risk in a disaster trade, not just a loser, but your per trade risk in a disaster trade is $64,000, or 6.2% of the account, not 20% of the account at the beginning. In other words, not only are you compounding, you're geometrically growing your profits, but you're also decreasing your risk. And by the end of year 5, you have decreased your single trade risk by almost 300%. So you're geometrically growing and you're decreasing your risk. Now, if you don't compound, just to give you a comparison here, if you don't compound, at the end of 5 years, the $25,000 turns into only $172,000, and your risk is about the same. It's a little more than 6.2% at that point. So you get almost the same risk, but about 1/8 of the profit potential. So this is a very, very important piece of the puzzle. Now, if you only have a $5,000 account, you can start off and you can turn in year 1 using the same money management strategy, starting with 1/5 of the trade size and increasing based on the same ratio. But year 1, 5,000 turns into 38,000, 38,000 into 143,000 by year 2. By year 3, that turns into 320,000. Year 4, 568,000. Year 5, $890,000. You turn a $5,000 account into $890,000, and your risk at the end of that is only 6.7% of your account, not 20% of your $5,000 account that you begin with. So again, your risk drops almost 300%. Now, if you don't compound, at the end of 5 years, the $5,000 turns into only $34,500. Compounding is where you address the profit potential. So that gives you an idea of what this strategy is all about and what's available with the signals, and especially when you're talking about compounding. But just to recap, the signals are end of day. They're provided twice weekly. All fills are reported, are actual fills. We sell both puts and calls, and I realize that some people may not want to or cannot or do not have the risk available to sell calls. That's fine. There are plenty of put option signals. There's probably 2 to 3 times more put option signals than there are call option signals anyway, just because we require, for my own self, we require a little bit higher standard for the calls. The exits are fully explained. The trade size is fully explained in that webinar, and a spreadsheet is provided for you. And there's absolutely no guesswork in any of this. Now, the subscription is absolutely limited. All the trades, we take all the trades. So I have to limit due to volume. And I do expect that this subscription will fill up within the next 30 days. So what do you get with a subscription to the Options for Profit stock signals? You get 1 year of the stock signals, exact entry and exit signals for the stock options. The examples I've already shown you. You get the trade size compounding spreadsheet, and you get the 1 hour live class explaining the compounding. And that's a live webinar that's held on March 11th. So if you're watching this video and it's past March 11th, or you're not able to make the live webinar, it is recorded. So you will be able to access the recording if you missed it or have missed it. Now here's the offer. The first 100 who sign up for the entire year get it for only $497. So you get 1 year of the signals, you get the compounding spreadsheet, and you get 1 hour live webinar explaining the compounding. It comes to $41 a month. And just to give you some perspective on that, the trade that we exited today brought in $70 with a single option contract. So this can easily pay for itself with just one trade, one option contract on one trade per month. And here's how the price increases. So if you miss out on the first 100, the price goes up accordingly. The next 50 get it for $597 a year, the next 50 for $697 a year, the last 50 for $797 a year, and then it's over. We will not accept any more. Or you can, if you're not willing to commit to a year of this, it's $77 a month through March 15th, and then it goes to $97 a month until it is full. So that's the pricing structure. On the first 100, it's $497. We're already at around 40, so there's only around 60 left. So, you know, I say that it might last 2 weeks. Most likely, the first 100 are not going to last 2 weeks. However, I do want to caution you: if you're a tire kicker, or if you're one of these traders who does not commit to a strategy, or you take the deal because you want to be one of the first 100 and you don't want to miss out, and then you just plan on asking for a refund later. I want to make very clear there are no refunds with this subscription. The subscriber base to the OFP signals is absolutely limited. I only want traders who are committed to the program. Now, if this was not a proven long-term strategy, if the track records were hypothetical, if the subscriber base was not strictly limited, then I would probably offer a refund. But none of these things are true, so I do not offer a refund. If you're uncertain about whether you want to commit to this long-term, just simply subscribe at the monthly rate of $77, and as long as you remain a subscriber, your spot will be secure and your price will not change. Now, the probabilities in this strategy and with these signals, as you readily saw with the examples that I gave, the probabilities are absolutely fixed in your favor. So a loss or even several losses does not negate the future probability of success with this strategy. So drawdowns or losses do not constitute a reason for a refund. There's a 94 to 96 probability of success with each individual trade. And what that means is that there's a high probability that you can pay for the entire 1-year subscription with just the first few trades. So there is no way that I'm going to give this signal service at such a low rate. You have a very high probability of making back the entire cost within the first few trades, and then 3 months later, after you've profited and then suffer a loss or whatever, you decide to cancel and get a refund. Now, there are no refunds. These signals are for me and my risk tolerance levels and my goals. I cannot and do not tailor the signals for each subscriber based on their own circumstances. Okay, so when I place a trade or when there's a signal, it's a signal that I'm willing to take. If you're not willing to take it, that's fine. If it's one that you're uneasy about, don't take it. That doesn't change what I'm going to do. These signals are based on what I'm going to do, and you can either choose to follow them or not choose to follow them. And again, at this price, and based on the proven track record, even with that, in the first 100 subscribers, again, I say 2 weeks, but probably not even going to last that long at this rate. Nonetheless, I will notify you via email as we approach that first 100, so you will have warning. If you want to take advantage of the offer, you can go to the following link and you can take advantage of the offer. The 1-hour compounding webinar and the spreadsheet will be held on March 11th. You'll get information on that in your email once you subscribe, but it is only for the 1-year subscribers. So if you subscribe to the monthly and you want this recording, you'll have to pay extra for it. If you have any questions, feel free to email us, and we will be more than happy to answer email, or you can visit live chat, talk to our support team via live chat. I hope you've enjoyed the presentation.